Welcome back to the Alternative Investment Show. My name is Kerry Stevenson, serial entrepreneur, real estate investor, share market investor, gold tragic, well actually gold investor. And I am passionate about helping people protect and grow their wealth, especially in these really crazy times we find ourselves in. And I've managed today to get a really special guest, somebody I've known for quite some time, but somebody who actually understands investing in the share market, etc. Because I've had a lot of you reach out to me, people that have just put their money in the bank and really don't understand share markets, don't understand investing. So what we're going to do today is we're going to speak with Henry just about what are the basics, why should I invest, where should I put my money? You know, interest rates are now at ridiculous lows, so you're not going to get interest rates in the bank. So what do you do? But before I start chatting with Henry, let me give you a little bit about him. Henry's been involved in the financial markets since the 1980s. He was a member of the London Stock Exchange. He came out here from the UK, so he's a POM, but we'll forgive him for that. In 1989, joined Macquarie Bank. He was in charge of Australian equity and derivatives trading. Then he went into private client broking, and that's the key here, guys. Private client broking. He understands you as the sort of the investor out there, individual investors, and what you should do. He joined the financial newsletter Markets Today in 2015. And some of you might have seen him. He's a little bit of a guru superstar on, I think, CNBC, Sky News, Sky Business, etc. So that's enough about you, Henry, from Markets Today. How are you?
I'm fine, thanks, Kerry. How are you?
I'm great. And listen, thanks for your time, because I know you're a busy guy.
Always a pleasure.
As I said in the introduction, there's a lot of people out there that have been talking to me and saying, I don't even understand. And this is basically, Marcus, for people who, Henry, who are 19 years old up to people in their 50s. They've never invested in shares. They're getting worried. What's your advice? Like, let's start from the beginning.
Starting from the beginning. I mean, a lot of people don't invest in shares because they don't understand them. And I think that's a major problem. And they like to go towards property because it's bricks and mortar. They can see it. It's tangible. It's not that complicated. But unfortunately, well, not unfortunately, but the costs involved in getting into property can make it quite prohibitive, especially if you're just starting out. And they call them, some people call them the Henrys, the high earners, not rich yet.
I've heard that one before.
So there's a lot of people that are, I talk to a lot of young guys in their 20s and just starting out on their careers and starting to get some money behind them and looking to how they can grow that wealth. And one of the biggest ways of growing wealth is investing. Now, I look at share investing as opposed to property investing or yourself as in gold or alternative investments. But share investing is a very easy, accessible, cheap way to start building wealth and start building what they call a portfolio, which is I guess a bunch of stocks and a bunch of assets that perform sometimes the same, sometimes differently in different environments. But certainly building wealth through shares is what I have been involved in for an awful long time. And I guess it's my passion, and certainly for the last 5 years with Markets Today and previous to that with broking, that was what
I'm just going to stop you there for 1 second and just to explain to people. Owning a share in a company just means that you own a smidgen of that company.
Exactly.
So if you're going to invest in shares, all you're doing is you're buying, if you've got 10 shares, you've got a tiny, 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 tiny bit of that company.
Tiny bit.
If that company does well, Henry will explain what happens.
Yeah, that's exactly right, Kerry. I mean, it is basically you're buying into a business, and the business that you're buying into divides the business into shares of that business, and you can buy 1 share or 2 shares or 1,000 shares or as many shares as you can afford, up to a limit, of course. But that is you're buying into that business, so your success will be governed by the success of that business. Now, your success will be managed or be in 2 ways, either through capital gain, in terms of how that business grows, or in terms of how the company pays you as an investor in that business a share of the profits, what they call a dividend. So many companies, especially in Australia, pay out dividends. So the company makes a profit for the year of $100. They decide to pay shareholders out $10 worth of that $100 worth of profit. They keep $90 for themselves to reinvest in the business, and that $10 is then split between the shareholders. And there are various tax benefits as well surrounding dividends, which make Australia quite unique in the world.
What are those tax benefits, Mark? Henry?
Well, basically, we have a tax system where you can we get franked dividends. So depending on your tax position, you can get sort of a rebate from the tax office in terms of how much tax you pay on that dividend or have not paid on that dividend. So it gets a little bit complicated, but it basically it's to try and stop double taxation. So the company is taxed at one level, and then the idea is that you're not taxed any more than that. So it does make Australian dividends quite attractive, and many investors, many shareholders go into the banking sector for that very reason, because banks offer a very big fat dividend yield, and they also offer big franking credits. You can only offer franking credits if you pay tax in Australia. So domestically focused businesses will be good for those franking credits. But at its essence, as you say, Kerry, buying a share in a business is just that. You are buying a share in a business. So if you walk down the high street and you see Westpac or Commonwealth Bank, you can buy a share in that business, and you get the benefit of their growth and their dividends over time, depending on their profit levels.
Okay, so right now, as we sit here chatting, the share market is a little bit volatile, has been for a while. Some people say that it's a bit toppy. So there are people out there that are what I call the nervous Nellies. You know, they like to see their money sitting in the bank. And basically, ladies and gentlemen, if your money's sitting in the bank, it's going backwards because of inflation, but we'll talk about that later. And but people don't understand. They look at the market volatility and then they get scared. What would you say to people who don't really understand why they should do it, and what's in it for them? Why should they do this?
Well, I guess that it's Einstein that once said that the biggest power in the universe is the power of compound interest, and that really is the key to it. Starting early, starting often, and regularly investing does take away some of that volatility. So you're investing in good times and bad times. And just to put it in perspective, it was only February the 20th that we were at an all-time high. That's less than 2 months ago. And we've gone through a bear market, there's an official definition of that, and a bull market in the last 2 months. So to say it's been volatile is somewhat an understatement to say the least. But the great thing about shares, and the great thing about any investment, is this power of compound interest. So the fact that you're getting a dividend, or the market grows by 7 or 8% a year, does reflect over a long period of time in doubling, trebling. It's just the power of that interest rate. So the earlier you start, the better. The more consistent you are with putting money in, the better. The more regularly, also the better, because that does smooth out that volatility. We call it dollar cost averaging. So you may invest $1,000 every month. Doesn't matter whether the index is at 7,000 or 5,000 or 4,000. You just get more bang for your buck when it's at 4,000 than when it is at 7,000. So dollar cost averaging, especially if you're young and starting out, is a great way to play it. Investing in any kind of market, but certainly in the stock market. Now,
and what Henry means by that, ladies and gentlemen, is that, you know, if, for example, Westpac shares are at $40 1 year, and you want to invest $80, you'll get 2 shares. But if it then goes down to $20, you'll get 4 shares. And Henry, I'd like to just ask you briefly, while we're on this sort of part of it, can you just explain because I always say to people, you know, if you don't need the cash now, do a DRP, which is the dividend reinvestment plan. And you can probably explain that a lot in a lot better language than I would.
Well, one of the great things, especially when you're starting out, is the ability to take the dividend that whatever company gives you, and instead of taking it in cash, which you'd only fritter away on smashed avocado and frivolous things like having a good time and holidays, etc., is to actually take that money and reinvest it back in the company whose shares you've got. And many companies do what they call a DRP, which is a dividend reinvestment plan. So they offer you the facility to buy shares in the company instead of taking cash. Now, that's for the company, it helps them. They don't have to pay any cash out. All they do is issue with new shares. But also for you as a shareholder, it builds up your shareholding, because instead of having 100 shares, you start to have 105 shares and 110 shares and 120 shares. So over time, your portfolio grows, although your cash balance doesn't. So that means that if you're starting out and you don't need the cash now, it's a great way to start building it. And many people or many companies provide the DRP at a discount, what they call a discount to the share price. So you may get those shares at, say, a 2% discount to the price they nominate. So you're getting a little bit of a kicker there as well. So especially if you're in a wealth accumulation phase as opposed to retirement phase where you're looking for income, DRPs are a great way to build the size of your portfolio, so much so that you don't actually notice it to some extent before it starts to get really big and really tangible, I guess.
Okay, so that's great. Let's go right back to the basics, because I've had, as I said to you before, I've had a lot of people, you know, from my nephew who's 19 years old, right up to friends of mine in their 50s who say, but where do I start? There's so many different platforms. What would your advice be for somebody that scratches their head and says, I've never invested in shares in my life? Do they go big? What platform do they use? How hard, how easy is it?
It has become really easy, Kerry. The technology is remarkably simple, and there is remarkably a number of not only newsletters, but websites, all sorts of information out there. There's a ton of information out there now that people can go through. A good place to start, I would say, is just to start reading the Fin Review and trying to work out what's actually going on in the business world. It's not a huge read anymore. It gets thinner by the year, but it certainly is a good place to start and just to develop an interest. There are many free information services out there, and you only have to start Googling things before you'll find yourself on the mailing list of God knows who and how many of these people trying to flog you something. Everyone wants to flog you something, so I'm not going to do that here. But the other place to start is you need a platform to actually access the stock exchange and buy shares. You need a platform. Now, for beginners, I would stick with names that you know and names that you can trust. Probably the biggest one is CommSec, which is a branch or a division of Commonwealth Bank. It has a very good platform that has been around for a long time. Signing up as an individual to open a share account is not that difficult anymore. There's a few ID checks, but as long as it's just for you in your name and not some company entity or a super fund, etc., it's relatively simple and a relatively quick process. Once you're into the platform, be it CommSec, there's NABs have one, NAB Trade, Westpac have one as well. I would try and avoid the sort of the less well-known ones and the CFDs providers that will try and push you into things, the CMCs and the IG indexes. I would stick, if you're starting out, to something like CommSec, ANZ's E-Trade, or as I say, Westpac or NAB. Stick with one of those to begin with. You can always diversify it, and there are cheaper ways to invest. But to be honest, the commission rates they charge are pretty competitive. You can get cheaper, but just starting out, commission should...
Yeah, and I think you're right. I think, you know, for those that are listening now, and we're doing this program because I've had so many questions about investing in shares. So, you know, I do totally agree with Henry. Go with one of the big four, because you know that you're going to be safe and secure there. It's very simple. I don't believe that you have to be a bank customer to open up a share trading account. So you can go to CommSec or E-Trade with ANZ or NAB or whatever and just open it up. And my advice, by the way, I am not a financial advisor. I am just a serial entrepreneur and investor. But my advice is, if you don't start somewhere, you're never going to start anywhere.
Good advice.
And do you find that as well, Henry? Do you find that there's a lot of, I guess, procrastination from some people that say, shoulda, coulda, woulda? Yeah,
and the sooner you start, the better. And the great thing about shares, as we talked about earlier, is they're really relatively cheap to access. But, you know, for $20, $25 in commission, you can buy an awful lot of money's worth of a company's or a share, whereas it's very hard to go and buy a share of a house or a unit or an apartment. So it makes it a lot easier to access and to build that start building that wealth. The sooner you do it, the better. And once you get onto one of these platforms, say ComSec, for instance, not that I'm pushing them for any particular reason, apart from the fact they're the biggest, is that there is an awful lot of information there on the website in terms of research, whether that's what they call fundamental research, which is actually looking at the company's balance sheets and the numbers and the sales and those sorts of ratios, or whether you're more a kind of a technical, what they call technical analysis of a stock. So that looks at what I call the wiggles and squiggles. That's the chart of the share price movement, and there's a lot of technical stuff there. So it shows you in kind of a nice representative form where the shares have been, what they've been doing recently, and you can then kind of draw out where you think, or where the market thinks those shares could be going based on those lines on the computer screen. So there is a lot of information on those trading platforms. Their job, after all, is to get you educated and get you to trade. The other great place to start as well, if you're just
now hang on, I'm going to interrupt you. You said and get you to trade. Now, I quite often say to people, if you're going to start investing, invest, don't trade. There is a big difference. And you can lose your shirt when you start trading.
There is a big difference. There is a big difference between investing and trading. It really comes down to timeframes and activity. Investors tend to buy and hold and stay in a stock or in a market for an awful lot longer. Traders tend to be on a shorter time frame, be more active. Now, I would agree with you, Kerry, to a huge extent that there is a massive difference between investors and traders. The only thing I would say is that the market has changed, and I think you need to acknowledge the fact that sometimes as an investor you need to be a trader and need to look at the short term to avoid potential problems, and being wedded to one share forever is not the greatest way to build wealth, because the world changes. You know, it wasn't long ago that Apple was just a computer company, and it was only 12, 13 years ago that we had the first iPhone that came out and changed the world. So the world is very dynamic. So I think as an investor, you have to be dynamic. Now, whether that makes you a trader or not it's up to you, how active you want to be. It may be that you like trading, but you know, investing for the long term will build wealth. But certainly the markets move, and certainly things happen now so quickly that you need to keep a weather eye on what's going on, and can't just set and forget and blindly put in your $1,000 every month to the AMP, hoping that it's going to keep going up forever, when in fact it's in serious problems. So I think that's important to remember in terms of that.
Yeah, and I think that's a very good point, because a lot of people, you know, we talk about superannuation, and you know, there's a lot of superannuation, and people's money goes into their super fund. And I talk to people about it. I goes, so how much money do you have in your super fund? I don't know. And I say, well, you should know, and you should know where it's invested, and you should keep a weather eye on it, because it's your money.
That's right.
And so my passion is to wake people up to the fact that it's your money. It's not the superannuation company's money. And if you want to change things in it, do so. And I think you gave some very good advice. As much as people will turn around and go, oh, Financial Review, it's too dry. Well, actually, it does get pretty interesting when you start to find out about things.
It does. And also, you know, there's, you know, 80% of it is complete waffle, because it just is trying to sell adverts to people. But there's 20% which you will find that is really useful. And over time, you will learn to read the bits that are useful and that do have a bearing on your interests and your situation. And it is very interesting. The other place I would start with, if you're just starting out, which is a fantastic resource, is the ASX itself. The ASX.
Yes, I was going to talk about that. The ASX itself is brilliant.
Yeah, which is the Australian Stock Exchange. So the ASX.com.au has a huge wealth of videos and education articles about the market, how to get started, how to find a broker, because you don't have to go with a ComSec. You can actually talk to a real person and find a real stockbroker. They do exist still, although they are a rare species these days. They will charge you more money, but you have got some experience by your side. And if you find a good one, they can add considerable value and give you some great ideas, and of course access to their research, which can be quite beneficial. So it's not just about a platform, it's not just about using technology, It's also about the old-fashioned way of finding someone you can trust. And brokers, unlike financial planners and that side of things, who charge whatever, depending on the service they provide, the broking community has a commission structure. So you can talk to the guy for 4 hours, and if you don't trade, it doesn't cost you anything. It is just on commission. So they have to give you ideas and give you value. And if they don't, then you wouldn't be talking to them. So, and their commissions range depending on their, how much you're investing and how much you're playing in the market with. But certainly the ASX website is a fantastic resource, a great place to start. And not only can you look at shares, individual shares in companies, there's been an explosion in the last decade in what we call exchange traded funds. And these are big funds run by big money managers that basically can be a passive investment into a market or an instrument. Now, in your case, Gary, I mean, you've obviously seen there's a gold ETF, and there's oil ETFs, and there's all sorts of alternative asset kind of ETFs, exchange traded funds. There's also, you can buy, if you wanted to buy NASDAQ stocks, and you were prohibited by doing that because of the costs involved and the complication, but you wanted to buy US technology, there is an exchange traded fund that trades on the ASX platform that you can buy through your stockbroker or through CommSec, which gives you direct exposure to NASDAQ stocks. So if the NASDAQ index, which is a big technology index in the US, if that goes up by 2 or 3%, your ETF will go up by 2 or 3%. It mirrors that performance. So you don't even have to say, I want to buy Amazon or Apple or Facebook or Google or whatever. You can just say, I want to buy all of them, and this is the way to go. And it's a huge business in Australia. I think there's over around 220 ETFs now in this country. There are thousands in the US. Anything you want to trade, you can trade, and they've got great names, some of them.
Well, do you know what, Henry? You've because I mean, I've been investing for far too long. I've done well some years, not so well, but I never knew there was a NASDAQ ETF, because I've often wondered, you know, I should put some money into some of the alphabet stocks. And so to those people that are listening, you are never too young or too old to learn. So
there is one for every occasion, Kerry. I've got to say, because the codes of some of them are great. There's one that invests in world pharmaceutical companies. That code is DRUG, drug. There's one that invests in all the cybersecurity companies, and that's called HACK, H-A-C-K. So these are all their stock exchange codes. So and there's one that invests in global food companies, and guess what that code is? Food.
Oh, couldn't be food, could it?
Good. And there's one on oil, and that's oil. So there is one for every occasion now, and it's been a massive kind of boom in the market in these ETFs.
Do you think ETFs, so, you know, as you know, I love gold, but I love physical gold, I love gold equities. You know, for me, the gold ETF to me is just more paper. And I'm the sort of person that says I like to invest in things that are not just paper. Would you recommend GLD and would you recommend ETFs generally, or should people be investing direct with the companies?
Well, I think if you're just starting out, ETFs are a good place to start, especially if you're looking at asset allocation. And that's one of the keys to it, is asset allocation, saying, okay, I've got $100, and I'm going to invest 20 of those dollars in US stocks. I'm going to invest 20 of those dollars in Asian stocks, and I'm going to invest the other 60 in Australian stocks. Now, you can go down to individual company level, especially if you're dealing in Australian stocks. But if you're dealing in Asian or North American stocks, the costs there are not as cheap as they are here, and they're a little bit more complicated. And it's harder also to get some of the research and get a feel for them, because we're in a different time zone. So sometimes it's easier just to go, okay, here's my $20, it's going into American stocks through an ETF, and here's my other $20, it's going into Asian stocks through an ETF, and then you're sorted. And then sometimes also it can pay if you really think the market's going higher or lower, and you can even buy an ETF that profits when the market goes down, which can hedge your exposure. Then you can get set quite quickly in an ETF, and then you can decide which shares after that are the actual ones you want to buy on further investigation. So they are a really useful product, especially for that asset allocation, especially when it's harder to get exposure to those different assets. It's really easy to phone up a broker or on your platform to buy a share in Telstra. That's really easy. But if you wanted to buy a basket of telecom stocks around the world because you thought 5G was going to revolutionize the world as we know it, without killing anybody with coronavirus in the process, then you could just buy that ETF on telecom stocks, and that would give you a global exposure to. So even if Telstra's not that crash hot, but Deutsche Telekom does really well, or British Telecom.
Yeah, so you've got exposure across the board. Yeah,
and it does give you some diversity, because when you're building your portfolio, not so much when you start out, because it's harder because you only have limited resources, but when you start building it up, you want diversity of not only of different stocks in that portfolio in case one goes bad, but also in case you have asset allocation issues. So you don't want all stocks. You might put in some gold, some physical gold. You might put in gold miners as well, because they have leverage to the physical gold price. You might put in whatever you want to put in to give you a diversity and try and the key to investing, the big sort of nirvana that we're all trying to do, is to get the risk as low as possible and the return as high as possible. And it's that balancing act between risk and return that is the tricky one. And you can buy some very speculative stocks in Australia or anywhere that will give you a spectacular return, but the risk is that they will just go bang and do nothing forever. So it is a balancing act, and that's the key. Starting out is to try and balance that risk versus return. And of course,
so I guess what Henry's saying is, don't gamble your money. Make sure that you understand what's going on. Henry, we're almost out of time, so I want to ask you two things.
Yeah.
Firstly, in 30 seconds, what's your advice to somebody who doesn't understand? We've talked about the stock market. We've talked about investing. 30 seconds. What's your advice to somebody who doesn't know anything? What should they do? Get started today. Wait for the market to hit rock bottom or go sky high. Over to you.
Get started today. Get started as soon as possible. Get educated. Go to the ASX. Read. There's millions of books on finance. Start following the market. Start watching and reading the AFR and get amongst it, I guess. The other thing to do, as far as market timing goes, there's never going to be a good or bad time. It is a question of being in the market for a long time. And even though we're seeing extreme volatility now and a correction, over a long period of time, you will do better than you will by having your money sitting in the bank rotting away. So get into share investing or any investing as soon as you can, because otherwise it's just dead money.
Okay, and now what I want to do is talk very briefly about markets today, because it's all in the background for you. I don't have a background, I've got a cupboard. It's a daily stock market newsletter.
Yep.
Let's talk a little bit about what is Markets Today, what do you do, and how does it benefit people who are investing?
Okay, Markets Today is a financial newsletter that's been going at just around 20 years. We try and tell it like it is. We also try and entertain as well as educate and give stock ideas and recommendations and strategy. We cover the whole of the Australian market and a bit of the US market in some respects. We've got two main writers for the newsletter, myself and Marcus Padley, who's quite well known on the ABC as well. We've both been around for an awful long time, and we kind of try our best to make you guys money. And you can sign up for free trials, but there's lots out there. We're not the only.
Where do they sign up for this free trial? How long?
They can go to marketstoday.com.au. They can sign up for a free 2-week trial. And I specialize myself in small caps, tech, a bit of strategy, well, a lot of strategy, macro stuff, and some of the mining stocks as well. Whereas Marcus is more a numbers man. He loves his Excel spreadsheets and charts, whereas I'm more a narrative kind of guy. So with the yin and yang to some extent. He's technical and numbers. I like stories and narrative and small.
And good management.
And good management is always the most important thing.
Absolutely. Henry Jennings from Markets Today, thanks very much for joining us on the Alternative Investment Show. We'll probably come back to you again in a month where we'll take it up a notch and we'll go into a little bit more technical detail about where the markets are heading and perhaps some of your advice. Thanks for joining us today.
My pleasure, Kerry.